In 2025, investing is no longer an activity reserved for finance professionals or wealthy elites. Thanks to modern technology, educational resources, and a wide range of easy-to-use investment platforms, virtually anyone can become an investor. Whether you're a college student, a young professional, or someone approaching retirement, this comprehensive guide is designed to help you understand how to start investing with confidence and purpose. The world of investing may seem intimidating at first, but with the right mindset and strategy, it becomes a powerful tool for building long-term wealth, achieving financial independence, and securing your future. Understand the basics. Key investment terms. Before diving into investing, it's essential to understand the basic terminology that you'll encounter frequently. The most fundamental concept is a stock, also known as equity. When you buy a stock, you're purchasing a small ownership stake in a company. If the company performs well, the value of your stock can increase, and you may also receive dividends. Another common investment is a bond, which is essentially a loan you give to a company or government in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks, but they also offer lower returns. Mutual funds are professionally managed investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. These are ideal for investors who prefer a hands-off approach. Exchange-traded funds, ETFs, are similar to mutual funds but are traded on stock exchanges like individual stocks. They offer diversification at a lower cost and are popular among passive investors. An index fund is a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500 or Nifty 50. Index funds are cost-effective, diversified, and ideal for long-term investment. Diversification is a risk management strategy that involves spreading your investments across different asset classes to reduce the impact of a poor-performing asset on your overall portfolio. Asset allocation refers to how you divide your investments among different categories like stocks, bonds, and real estate. Risk tolerance is your ability to endure fluctuations in the value of your investments without panic selling. How to start investing in 2025 step-by-step plan. The first step towards successful investing is defining your financial goals. Ask yourself what you're investing for. Are you saving for retirement, building wealth, planning a major purchase like a home, or setting aside money for your child's education? Knowing your goals helps determine your investment strategy, including your time horizon and risk tolerance. A long-term goal like retirement allows for a more aggressive investment approach, whereas a short-term goal may require a more conservative strategy. Next, before you begin investing, it's crucial to build an emergency fund. This is a financial cushion that can cover at least 3 to 6 months of living expenses in case of unexpected events like job loss or medical emergencies. Keep this fund in a high-yield savings account so it remains accessible and safe. This step prevents you from having to withdraw your investments in times of need, which could result in losses, especially during market downturns. After you've established your emergency fund, focus on paying off high-interest debt. Debts like credit card balances, personal loans, or payday loans often carry interest rates upwards of 15% or more. The returns you earn from investing are unlikely to outpace these high interest rates. By eliminating such debts first, you create a more solid financial foundation and reduce the risk of undermining your investment progress. Once your finances are in order, the next step is choosing a reliable investment platform. In India, popular apps like Zerodha, Grow, and Upstocks offer user-friendly interfaces and access to stocks, mutual funds, and ETFs. In the US and globally, platforms like Robinhood, Fidelity, Vanguard, and Webull are great for beginners. If you're looking to explore cryptocurrencies, use reputable exchanges like Coinbase or Binance. But remember to keep your crypto exposure limited due to its volatility. Investment options for beginners in 2020. When it comes to choosing where to invest your money, the options may seem overwhelming, but a few key choices stand out for beginners. Index funds and ETFs are among the best places to start. These funds offer broad market exposure, low fees, and minimal management. For instance, investing in an S&P 500 ETF or a Nifty 50 ETF gives you exposure to the top-performing companies in the US or India, respectively. These funds tend to deliver reliable long-term returns and are ideal for passive investors. Another excellent option is mutual funds, especially if you prefer a hands-off approach. In India, you can start with a systematic investment plan, SEP, which allows you to invest a fixed amount every month automatically. This not only makes investing easy, but also instills financial discipline. Mutual funds are managed by professional fund managers, so you benefit from their expertise. If you're more hands-on and want to dive into company performance, investing in individual stocks can be rewarding, though riskier. Focus on well-established companies with strong fundamentals, commonly known as blue-chip stocks such as Apple, Microsoft, Amazon, Reliance, or Infosys. These companies tend to be more stable and less volatile compared to smaller, less established firms. For those interested in real estate but lacking the capital to buy property, REITs, real estate investment trusts are a fantastic alternative. These funds own and manage real estate assets and pay out dividends to investors. REITs allow you to benefit from the real estate market without the hassle of managing property. Bonds and fixed income instruments offer safety and predictability. Government bonds, corporate bonds, and fixed deposits provide steady returns, typically ranging between 6–8% in 2025. These are especially suitable for conservative investors or those nearing retirement who prioritize capital preservation. Finally, cryptocurrencies such as Bitcoin and Ethereum continue to attract attention. However, due to their high volatility and regulatory uncertainties, it's recommended to allocate no more than 5–10% of your portfolio to crypto assets. Only invest in cryptocurrencies if you understand the risks and are prepared for sharp price fluctuations. How much should you invest? Many beginners wonder how much they need to invest to get started. The truth is, you don't need a lot. What matters more than the amount is your consistency. A useful budgeting method is the 50–30–20 rule. Allocate 50% of your income to needs, like rent and groceries, 30% to wants, like shopping or travel, and 20% to savings and investments. Even investing $500 or $10 a month can create a powerful habit that grows over time. As your income increases, you should aim to gradually increase your investment contributions. Try to invest at least 15–20% of your income regularly. Over time, this habit will build a solid financial base and allow you to benefit from long-term growth. Building your first portfolio. Creating a beginner-friendly portfolio is all about balance and diversification. For someone in the 25 to 35 age range, a sample portfolio might include 60% in index funds or ETFs like the S&P 500 or Nifty 5, 20% in mutual funds for diversification, 10% in bonds for stability, 5% in REITs for real estate exposure, and 5% in cryptocurrency if you're comfortable with the risks. The key to long-term success is to review and rebalance your portfolio periodically. At least once a year, check if your asset allocation is still aligned with your goals and risk tolerance. If certain assets have grown disproportionately, consider rebalancing to maintain your desired allocation. Mistakes to avoid as a beginner. Many new investors fall into common traps. One of the biggest is trying to time the market buying and selling based on short-term news or emotions. Even seasoned professionals struggle to consistently predict market movements. It's better to adopt a long-term approach and stay invested regardless of temporary ups and downs. Avoid chasing hype or investing based solely on social media trends or tips from friends. Always do your own research and understand what you're buying. Another mistake is failing to diversify, which can leave you overly exposed to a single asset's performance. Spread your investments across sectors and asset classes. Don't panic and check your portfolio every day. Markets naturally fluctuate. Frequent checking can lead to emotional decisions and impulsive selling. Lastly, don't invest without a goal. When you know why you're investing, it's easier to stay committed during tough times. Automate your investments. One of the smartest ways to stay consistent is by automating your investments. Automation ensures that your money is invested regularly without needing to make manual transfers each time. This technique also helps you benefit from dollar-cost averaging, which smooths out market volatility over time. In India, this is easy through systematic investment plans, SEPs. In the US, platforms like Robinhood and Vanguard allow you to set recurring investments. Automation helps eliminate emotional investing and makes the process almost effortless. Continue learning and stay informed. Even after you begin investing, it's vital to keep learning. The financial world evolves constantly, and staying informed will help you make better decisions. Read books like The Intelligent Investor by Benjamin Graham, The Psychology of Money by Morgan Housel, or Rich Dad Poor Dad by Robert Kiyosaki. Follow credible YouTube channels, listen to investment podcasts, and keep up with financial news. Education is your best defense against poor decisions. The more you know, the more confident and effective you'll be as an investor. Final thoughts. Just get started. The most important lesson for any beginner is this: don't wait for the perfect moment to start investing. The perfect time rarely comes, and time is your greatest ally in investing. Even small amounts invested regularly can snowball into significant wealth over time thanks to the power of compounding. Take control of your finances. Build your emergency fund, eliminate debt, and start small with low-risk, diversified options. Make investing a habit, automate it, and be consistent. Whether your goal is early retirement, buying a home, or simply achieving financial peace of mind, investing is your pathway to a better future. So that's it for today. If you like this video, then please hit the like and subscribe button for more videos. Thanks for watching.